Do you expect silver to ever come back down again, or is that
No.
it?
Yeah, well, it'll come down again, but it'll come down from a new reality. In other words, in both of those moves, if we further examine them, I don't have the charts here, but if you go back to that 79 to 80 surge at the tail end of that bull market that had been underway since 76 low. Okay. In the last 6 months of that move, there was actually a correction in the middle of that move. And
I
no
can bring it
doubt,
up again if you want me to.
if you can, you won't be able to see that on the log scale, I don't think. Well, yeah, you could see it in 2008. There's an example there. You'll notice about 3 months after the green circle, where silver surged from just above 20, it surged up to over 30, okay? You had a bad month. No, the middle chart.
Middle chart right here.
The price chart. The middle one, silver, is the middle chart. That one there. 3 months later, you surged. Then you had a bad month in January of 2011, where you had a straight down month. 3 months after that spread breakout, you had a surge in price, but you had a bad month in January.
Yeah.
No doubt everybody thought, oh, that's it. It's a blow off and you're through. Then you turned, and the next 3 months, you went berserk. Okay.
Yeah,
Same thing happened in 79 to 80. There was a pause in the middle of the move, spanning about 5 to 6 weeks, where it looked like, oh, golly, it's topping. It was just taking a breath. And then it tacked on the rest. So it was the 3 months, wobble around, confuse, then get there. When you get to the new reality in silver, and it could be, my guess is it's going to at least be 100. It's quite probable, possibly could be 200. That's a new reality. No, that doesn't mean you're going to stay up there. You can have a sell-off, but you're not coming back to 50. Your sell-off might be from 200 to 125 or something. You're in a new reality on silver then. The key is participating in the move into that new reality. And I think it's not going to be one of these things where you get to casually judge it along the way, if you know what I mean. If you're not there, you're not there. Okay.
Right. So in your opinion that's the move you want, to get there for that move, and then you can
after that, who cares? I mean, you've done it, especially if you're using anything with any potency of leverage, with futures or call options, especially. Again, the key is that spread. And that's our primary technical focus week by week in our reports. In fact, we're going to put out an update this afternoon on that. And I break it down into a weekly situation as opposed to monthly closes, because we're pressing at the levels that are key. And if you can get through them, it begins.
Kitty bar the door.
Yeah, and you don't need a headline. The reasons are built into the market. There's decades of underpricing of silver relative to gold, decades of underpricing silver relative to anything, the value of the dollar, not versus other currencies, but its real buying power, et cetera, et cetera. It made a mistake. Investors did. They let it get underpriced for too long, and they thought, oh, that's the new reality. No. Yeah. It's just like, we see it with market tops sometimes. Like, you make a bubble top in a stock market and you think it's just going to go up forever. And it gets overpriced way too long. And when it corrects, it just doesn't correct. It collapses. It doesn't need a new reason. It's the old reason that it's moving on.
Right. Talk to me about the miners here. What are you seeing in the miners?
Yeah, the miners were, just like silver has, they've underperformed since 2020 relative to gold. They broke out on their spread basis about 4 or 5 months ago. And if you'll notice, when gold stopped in April with 3,500 high, May, June, July, August, dead sideways, GDX exploded. The miners exploded. So when the spread broke out, it showed itself, especially even in the net price of the gold miners. They went vertical. You took, even Newmont went from $50 level, it's up to 84 in a heartbeat, new all-time new highs, okay? And people gave up on it. And in 5 months, about April, it started to turn. So a handful of months, it left the page and made a new high.
Right.
Did it need a reason? Yeah, the reason was it was underpriced in the first place. Okay. So anyway, that's what we're facing. And the miners, our expectation based on long-term spread analysis is that they could double to possibly triple in relative performance to gold. So as gold continues up, the miners will continue to beat it by large amounts. And when you go back to the 1980s, and look at relative performance of where gold, silver miners were in relation to an ounce of gold, like XAU index, for example, You could triple its, we're right now pushing 8%. You could go up to 17.5%, more than double from where you are now, just to get to the underneath side of the multi-decade range it prevailed in the 1980s, 90s, and into 2000. So that's how cheap they are. And their relative performance, they could ventilate on the upside in terms of place to be.
You know, people ask me all the time, Michael, is this it? Is silver finally making its real move? And I smile because I've heard that question for 40 years. The difference this time is that the market structure, the momentum, and the psychology are all lining up in a way that screams new reality. Let's just get one thing out of the way first. Yes, silver will have corrections. It'll come down again, but it'll come down from a new altitude. When I say that, I'm not being poetic, I'm being statistical. If you look at the history of silver bull markets, whether it's the late 1970s or the post-2008 move, there's always a mid-flight wobble before the vertical phase kicks in. Take the 79 to 80 blowout. Everyone remembers the Hunt brothers in that parabolic rise, but few remember that halfway through that run, silver paused for breath. You had 5, maybe 6 weeks of consolidation where everyone thought it was topping. Oh, that's it, it's over. Then it took off again, doubling before anyone could react. Same in 2010, 2011. Silver rocketed from $20 to over $30. Then it had a nasty drop in January 2011. Everyone panicked, and 3 months later, it went berserk, all the way to $50. So when I hear people today say, well, it's up too fast, I just shake my head. Fast is what it does when the system underneath it is breaking. That's not volatility, that's honesty showing up in the price. Now, if silver does what I think it's setting up to do, we're talking about a move that takes it to $100 at least, possibly $200. That's the new reality. Will it stay there forever? Of course not. You'll get a pullback, maybe from $200 to $125. But that's the point. You won't see $50 again. The floor rises permanently. The key isn't trying to guess every twist and turn. The key is being there when it breaks into that new dimension. Because once that lid blows off, you won't have time to casually reevaluate. Every major breakout I've seen over my career catches 80% of investors flat-footed. The herd waits for confirmation, and by the time they get it, the easy money's gone. And here's the beautiful irony. You don't need some earth-shaking headline to trigger it. The reasons are already baked into the market. Decades of underpricing, decades of monetary distortion, decades of assuming that silver doesn't matter anymore. That's what fuels the move. The same way markets get stupid on the upside, like the NASDAQ trading at 200 times earning, because everyone believes it's different this time. They also get absurdly cheap on the downside. And right now, silver's been insultingly cheap relative to everything. Gold, equities, even copper. When things are that distorted, you don't need a new reason for them to correct. The old reason, reality, eventually forces its way back in. Now let's talk miners, because if you've been following my work, you know I love the spread analysis between the metal and the miners. That relationship tells you where the smart money's rotating. Since 2020, the miners have underperformed gold badly. Everyone gave up on them, but then about 4 or 5 months ago, that spread broke out. And when it did, the miners exploded. Look back at April. Gold topped around $3,500 and went sideways for months. May, June, July, August, dead range. Meanwhile, GDX, the gold miner ETF, went vertical. Newmont shot from the 50s to the mid-80s in what felt like a heartbeat. And it wasn't because of some magical earnings report. It was because the ratio between gold and the miners finally broke out of a multi-year compression zone. That's how momentum works. It builds quietly, and then the release looks like an event. And the same investors who said, miners are dead money in March were suddenly texting me in July saying, is it too late to get in? No, it's not too late. But you don't want to be chasing. You want to understand why the miners are starting to outperform and why that's likely to continue. If you go back and measure the relative performance of the XAU index, that's the Philadelphia Gold and Silver Index, against gold in the 1980s, 1990s, and early 2000s, The miners traded at around 17.5% to 25% of the price of gold. That was normal. Today, that ratio is around 8%. Do you realize what that means? The miners could more than double relative to gold and still just be returning to historical averages. If gold keeps rising, and I believe it will, then miners aren't just going to rise. They're going to outperform by a wide margin. That's why I keep telling investors, don't get hung up on whether gold's too high. Look at where the miners are relative to it. They're still cheap.
I know if you look at a price chart, a current price chart, arithmetic scale of gold or silver, you think, oh, wow, it's just gone ballistic. I got to take profits. Okay. The bigger context is totally different than what you see on that screen. The screen looks like, yeah, I've gone ballistic compared to the price action that prevailed over the last couple of years, which is more layered. In fact, there was a period just April, May, June, July, August where gold was dead sideways. Okay. But this chart's very informative. I'm possessed by it, okay? As a technician. This shows silver price on a logarithmic or ratio scale chart. So, I've shown the period in 79 and 80 where silver, after going up for several years, went vertical, okay? And then there's the period in 2010-11, the green arrow and the lines, where you've been going up for years, and then in the last 2 quarters, you went vertical, okay? Mm-hmm. We've been going up for years, just like those, okay? Not vertical, arm wrestling all the way, torturing people, monthly consolidation periods, corrections, all that stuff that goes with the normal arduous bull market. We argue that you're at the gate of going vertical. And forget momentum now. We'll get into that later, and the key trigger for this we'll get into in a second. Just looking at the price charts, a log scale. If you measure what happened in the last 6 months of that vertical move that peaked in 1980, that's the red up arrow with the 2 horizontals showing where it started and where it ended. 6 months, you went from like $8 to 50, okay? So we mark that distance on the log scale chart there, okay? Forget that. Now let's go to the 2010-11 period, where you also went up to the $50 level. And in the last 6 months there, between the green horizontal upper line and the green horizontal lower line, you went up X amount there. Okay, we mark that with the green arrow. Now, when we take those 2 arrows, the green arrow showing the logarithmic dimension of that move, 2011, and the red arrow to the 1980 peak, and move them over to the present. At the present price, if you go vertical, and I'll give you that argument in a minute, equaling the 1980 surge, 79-80 surge, you go up to $200 or so, logarithmically. And if you match the move from October 2010 to April 2011, where silver went from like 20 something to 50, silver's going over 100 to match that ratio scale over in the next handful of months. Okay. Now, what's going to cause this? Well, aside from the certain fundamental arguments and also the fact that silver ain't going to stop at a triple top, guys. Okay. If you want to sell at 50, go be my guest. You'll be buried, okay? The question then is, though, once we get through that silly nonsense level of 50, because frankly it is nonsense because it's so many years ago that in real dollar terms, factoring in the degradation in the real buying power of the US dollar, remember it doubles and almost doubles in quantity every decade. So it's a junior version of the Weimar, okay? Silver would be $200 just to match the 1980 high or something.
So let's pick up where we left off. The dam is cracking. The pressure that's been building behind this global monetary system for decades is finally showing up in the one place that still tells the truth: the price of gold and silver. Now, if you're staring at your screen right now thinking, Michael, this thing's going up too fast. It's got to crash. Let me stop you there. The idea that something must fall just because it's gone up quickly is a symptom of living too long inside a manipulated market. Stocks go up for years, pumped by buybacks and zero-rate liquidity, and no one calls that a bubble until it implodes. But when gold or silver rise a few $100s, everyone screams, unsustainable. What's unsustainable is pretending that debt-based money can keep its value forever. What's happening right now is not a mania. It's the world finally recalibrating after half a century of lies. You can see it in the tone of the institutions. A few years ago, the big banks mocked gold. Barbarous relic, they said. No yield, they said. But here we are. Morgan Stanley's chief investment officer quietly shifting to a 60-20-20 model. 20% gold. Bank of America's Michael Hartnett proposing a 25-25, 25-25 portfolio with a full quarter in gold. And Jeffrey Gundlach, the bond king himself, saying it's time to move away from the 60-40 and into tangible assets. Gold among them. When the casino owners start betting against their own game, you pay attention. And look, I've been around this industry long enough to know how the tide turns. The first wave is always mocked. The second wave is debated. The third wave, that's when everyone pretends they were early all along. We're somewhere between waves 2 and 3. Institutional money is moving quietly, and you can see it in the ETF flows. The bullion-backed ETFs are seeing record inflows, even as retail investors are still half asleep. That's the tell. Big money moves first, always. And here's the paradox. The same dealers who 6 months ago were swimming in inventory are now running dry. The cost of carrying product has exploded. Shipping, insurance, hedging, everything costs more. And when demand snaps back, even a small uptick, the shelves clear out instantly. You know, I was just talking to a major distributor last week, someone who supplies multiple dealers, and he said to me, "Mike, I'm down to 3 weeks of silver rounds. That's it. And the refineries are backed up. That's with just whispers of mainstream interest." Imagine what happens when that 0.5% U.S. allocation to precious metals becomes 5%. Rick Rule said it best, that would be a 10-fold increase in demand. If it went to 20%, which Bank of America and Morgan Stanley are floating to their institutional clients, it's not a 10-fold increase. It's a 40-fold increase. 40 times more demand on an industry that's already running thin. You think the supply chain can handle that? Not a chance. You could have a 24-hour wipeout in availability. And that's not hyperbole. That's arithmetic. Every mint, every refinery, every distributor works on thin margins and limited capital. They're not prepared for a tidal wave. They can barely handle a ripple. That's why I keep saying this won't be a linear move. This will be a revaluation event. You'll have two kinds of people in the aftermath. The ones who say, "Man, prices got so high, I stopped buying." And the ones who say, "I can't get any. It's all gone." The first group loses because they got scared. The second loses because they waited. Now let's look at the futures market. You've got silver at $47.30, up big. Gold at $3,858, up $50 in a single session. That's not noise. That's signal. That's the sound of capital rotation. For the first time in decades, capital is starting to move away from paper assets and toward tangible ones. You can see it in the volume, the open interest, and most importantly, in the ETF flows. And these are not mom and pop buyers. This is institutional money, endowments, hedge funds, private wealth desks, finally realizing that paper promises can't hedge real inflation. Let me remind you of something very basic. When you buy a treasury bond yielding 4% and inflation's running at 8%, you are guaranteeing yourself a 4% loss in purchasing power per year. Over 10 years, you're guaranteed to lose nearly 40% of your real wealth. That's not an investment. That's a slow-motion robbery. Now add taxes. The IRS takes a quarter of your interest. So your 4% yield becomes 3%. Meanwhile, your dollar's losing 8%. You're down 5% a year for the privilege of lending money to a government that's already bankrupt. I don't know about you, but I'd call that a bad deal. And that's why gold's not rising. The currencies are falling. Every G7 currency, from the euro to the yen, to the Canadian dollar, to the pound, is deteriorating against gold. It's not a gold rally, it's a currency crisis in slow motion. And when you zoom out, you see the pattern. China, India, Russia, Saudi Arabia, all building vaults, all repatriating gold, all signing long-term trade deals outside of the dollar. You've got a new global gold infrastructure emerging across the global south, from Shanghai to Singapore to Dubai, from Hong Kong to St. Petersburg. You think that's coincidence? You think all these nations suddenly fell in love with shiny metal? Number. They're preparing for a world after the dollar, a world where settlement happens in gold-backed assets, where trust is measured by custody, not promises. And the Western world, still stuck in its debt bubble, is just beginning to realize it. Even the Bank of International Settlements, the central bank of central banks, quietly reclassified gold as a Tier 1 asset a few years ago. That means it's risk-free, equivalent to cash or treasuries. You don't make a move like that unless you see where the wind is blowing. Now, when you combine that with what Michael Oliver calls the lid coming off, the momentum breakouts in silver and gold, you get an explosive cocktail. His models suggest silver could hit $100 to $200 over the next several quarters. And he's not talking about hype. He's talking about structure. Momentum structure doesn't care about headlines. It measures force. It tells you when energy has built up to a point where it must release. And that release, that's what you're watching happen right now. Oliver also made a critical point that a lot of traders miss. Don't get faked out by sharp corrections. In every major bull market, there's a jolt, a violent shakeout that convinces weak hands to sell before the real leg begins. Think back to 2011. Silver hit $30, then dropped hard in January. Everyone said, that's it. Then it tripled in 3 months. The same psychology repeats, the same pattern. Only the prices change. And speaking of psychology, let's talk about denial. Because denial is the most expensive emotion in finance. Right now, you've got people who'd rather chase AI stocks at 100 times earnings than touch something tangible. You've got folks bragging about their paper profits in a system where paper itself is being devalued daily. It's like bragging about being the richest passenger on the Titanic. Meanwhile, the smart money is already in the lifeboats. You can see it in the behavior of the big players. The central banks are buying record amounts of gold. The COMEX vaults are bleeding physical delivery. The lease rates in London are skyrocketing. 5%, 6%, even 6.5%, which means there's extreme tightness in physical supply. These are not random signals. These are symptoms of a system under stress. And the irony? Most retail investors are still asleep. The public hasn't arrived yet. They will later and in panic. That's the beauty of asymmetric markets. When you're early, you look wrong. When you're late, it's too late. Now here's the bigger picture, and this is where it gets geopolitical. China's not just buying gold, they're weaponizing it. Every vault they build, from Hong Kong to Riyadh, is a node in a new monetary network, and that network is designed to bypass the Western financial architecture. When that system matures, trade settlement in the BRICS world won't happen in dollars. It'll happen in gold-linked digital units, blockchain-based certificates backed by real metal. That's the next phase. And when that happens, the West will have no choice but to revalue gold higher to prevent its own reserves from being arbitraged away. That's how you get $5,000 gold, $10,000 gold. It's not speculation, it's math. You can't service $35 trillion in US debt with a fiat currency that's losing trust. You need an anchor, and history's anchor has always been gold.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.